Hey, welcome. This is, as I've just been explaining to Brennan offline, the first David Anderson talking market data podcast. So I'm starting out fresh and new. But Brennan, this is not the first conversation you and I have had. I've had many a session in your New York office, or normally in New York, actually, rather than London, that I have been talking to you, and I want this to be an extension of it. I was looking up your LinkedIn profile. Mm-hmm. Gosh, it's a long LinkedIn profile. You must be really old. I mean, that's my first observation. I think it said, do you want to see the next 22 experiences? So, I mean...
A long and sordid history.
Yeah, I mean, the two bits that I'm most familiar with, but... Tell the audience a little bit more. I mean, I've known you with your Refinitiv, your Thomson Reuters, those sort of days with the sort of enterprise data side of things. That's where I think I got to know you best. But I also saw on there something I'm familiar with, the sort of BT Radiant stuff as well. I mean, give us the 30 seconds. Who is Brennan Carley? Why should we bother listening to him?
Yeah, so the 30 seconds, and I'll try and keep it to 30 seconds. So I guess, it's give or take about 40 years over the career, and it's always been at the intersection of business and technology, and in particular electronic trading and investment, and technology. And actually in university I did a dual major in computer science and economics. So I've sort of always had one foot in both worlds. It took a class in commodities trading and one in compiler and operating systems. So a little bit of both. So started my career at IBM writing software, and then moved into more sales, and product kind of jobs. Ran technology for Instinet, and wound up at Reuters.
Was it when it was owned by Reuters? I remember Reuters.
That's right. That was when it was owned by Reuters. Yeah. So, although when you were at Instinet at the time, you kind of were vaguely aware that Reuters was the shareholder, but you didn't really have much to do with Reuters on a day-to-day basis. But I basically shot my mouth off one time too many at a board meeting, and for my sins, I was asked to come to Reuters and do a strategy job. And the outcome of that was we wound up creating Radiance, which we then sold to BT about 5 or so years later. So, and I won't take you through every job, but basically, since then, it's always been in and around electronic trading and the data, the analytics, the connectivity, the technology that supports that activity. And I like to describe it's sort of been from the top of the stack to the bottom. So, at the bottom of the stack was spread networks, where we literally dug, trenches, blasted through mountains and laid fiber cables. And, at the top of the stack was more the actual electronic trading kind of activity at NYFIX and at Instinet.
And we're going to get on to that when we talk. I mean, I've got 3 topics that I'm going to talk to you about. And as I mentioned in the intro, I might split them into 3 short podcasts or 1 long one. We shall see how this unfolds. But right. I'm going to pick your brains about some of those sort of earlier experiences. In fact, let's dive into the 3 topics that I want to talk about. Mm-hmm. And I'll share this with you, but also the audience. My plan is we're going to be high level, because we only got time for a bit of high level on these. But my intention is that in subsequent episodes of a podcast, we'll have much deeper dives. So, Brennan, if you behave yourself on this podcast, I will, I'm sure, invite you back. Or if I behave myself, you might come back. So
I'm happy to.
That's the plan. So the first of the 3 topics is a very high level one. I mean, my career in the last, 35 years or whatever it is, has been 40 years in market data, but 35 years have been more on what I would call the market data systems. For my sins, right. Selling Triarch way back, so Triarch, RMTS, TREP, and I think it's now RTDS, or whatever it's morphed into. That market data distribution systems, either MDS or MDDS, depending which company you work for. And I just wanted to get your opinions on what is the state of that little sub-industry at the end of 2024? And I'm going to throw one particular element that I think has got a bit quiet, but it's a big thing for you over the years. Okay. Latency or low latency or ultra low latency. That was a really big deal 15 years ago, or I
Oh,
don't know when it was,
well,
but it's gone quiet.
it's gone quiet, but it always has been. So, do we want to start with low latency, or do we want to start with market data distribution or management systems?
Well, they're sort of linked. Market data distributions. I suppose one element of those was latency. I'm throwing that one in because it was something you and I often chatted about. But just give me the big picture as you see it.
Well, let's start with, I guess, with the market data systems. And as you can imagine, I've got some history around that. So if you go back, so I'll go back to the beginning of my career, and you went into a dealing room or a trading desk, as we call them on this side of the pond. What you had was stacks of monitors. So you'd have traders sitting in front of 8, 9, 10 of these CRTs, right? Cathode ray tubes.
Precarious stacks. I mean, they were actually dangerous.
Yeah, so I mean, they would be stacked up, and you'd have the different boxes and so forth, on top of the desk. A lot of them were green, some of them were just black and white, and you had a couple that were in color. And so you had, your teller rate screen, and you had your Proton screen, and you had your, Reuters screen, and et cetera. And at that time, actually, you probably didn't have a Bloomberg screen because that was 40 years ago.
Yeah.
But they were starting to creep in.
Yeah.
And the first kind of generation of systems to deal with that was the Rich video switching system. So
yeah, I remember
Rich Systems, named for a guy named Rich. And they basically you'd have one keyboard, and you could switch that keyboard to point to, the different screens, and you had the actual terminals were typically off the floor, and then you had the Rich video switch that basically channeled them onto the floor.
The CIS, the Composite Information System, I think it was, or
that sounds right.
I can't remember what CIS stood for. No, it's a long time ago.
I've forgotten some of the acronyms. But you had that, and basically what you had was there were a couple of firms early on that were saying, okay, we need to actually move to the next generation of dealing room, and it needs to be digital. So we want to put everything over a local area network. And at the time, people had religious debates about token ring versus Ethernet and so on. And Sun Microsystems, Sun Workstations, were starting to be adopted, basically because
Unix.
Yeah, and what drove that really was people wanted to move from just a human looking at a screen and making a decision to actually applying software and analytics to the data. So instead of just putting it on, photons on a screen, right? You wanted to actually have the data delivered electronically to a workstation where you could run all kinds of different applications that would analyze and basically help them make better trading decisions, on it, or help with risk management. And so that was kind of the introduction of the first generation of digital systems. I was at the time actually working for IBM and working with firms like Salomon Brothers, Goldman Sachs, and Morgan Stanley were really kind of the first three big banks, although they weren't really banks at the time. I mean, this was obviously before, Glass-Steagall was abandoned and so forth, right? So you had investment banks and you had banks. So they were really kind of the first adopters, and they adopted these Unix workstations. And Rich basically built what became Triarch as a way to replace the video switching.
Yeah.
Tibco, or actually as it was originally Technicron Systems, was a spin out from Stanford University, and they had built a messaging system, which, by the way, when they originally conceived of it, so Vivek Renadiv was the guy who started that, and Vivek didn't start it with the plan to be a market data platform. It was a messaging platform for all kinds of different use cases. But the guys at Salomon Brothers discovered it somehow, I don't remember how, and they said, oh, this is actually a good fit, for what we want to do, with a digital, dealing room. So the fundamental problem, that Triarch and Tibco, which was Technicron Information Bus Company, that they were designed to solve was not so much around electronic trading. It was around replacing green screens, basically, and delivering data to eyeballs.
Yeah.
So if you kind of fast forward, the biggest kind of transition in all that technology was the use case shifted, and it shifted from how do I deliver information to people looking at screens, and now it has shifted much more to how do I deliver data to machines and algorithms and applications that are consuming that data.
I mean, way back, I remember doing something with IBM years ago, and they had a paper. The last word of, will the last person to leave the dealing room switch the lights off?
Right.
That was and this is 20 plus years ago or something. And this idea that data feeds and this technology would almost remove the need for those trading rooms.
Right.
That was the idea. Has that happened? Or?
Yes and no. So, if you look at a lot of things, cash equities trading, right? There are very few people who are sitting at screens, executing those orders today. So on the bank or the broker side, you've got algorithms that are doing the bulk of the execution there. And then if you actually look at the execution venue itself, right, the exchange or the ATS or MTF or whatever the regulatory construct is for it, for that particular business, there you used to have people running around on the floor of stock exchanges with little slips of paper and so forth, and that end of it has been almost completely replaced with electronics.
Well, here's a really unfair question.
Mm-hmm.
Is that a good thing? That's a very subjective sort of.
Yeah, I think it's a good thing, because if you step back and you say, okay, why do the financial markets exist, right? What is the social benefit of the banks and the exchanges and so forth existing, right? It's basically to facilitate the raising of capital so that businesses can be created. And if you're going to raise capital, people want to have some way that they can exit, so they might invest in a business that they think is a good growth prospect. So if you're starting a business today, you might do something in green energy, solar, electricity, whatever, right? So you need capital to start and grow that business. But most shareholders don't want to hold it for 20 years, right? They want to exit. So you need to have liquidity. So you say, okay, what is going to make that liquidity efficient, readily available, and so forth? And the markets today, if you look at the cost of trading, is pretty close to zero. The availability of liquidity, is ubiquitous. So ultimately, the markets are performing very well for the most part. There's obviously always exceptions, but they make it much easier, to trade and therefore much easier to raise capital, which I would argue is socially beneficial. There's fewer people involved in it, but I think
it's an efficient market. I mean, I did my degree in economics, so I think perfect information was one of the things for a perfect market. But I mean, I'm not getting political, but I'm getting a bit controversial here. Mm-hmm. Is it a fair market? I mean, I was going to quote. I'm sure you were quoted in Flash Boys by Michael Lewis. That famous book.
A few times.
And I think a vast simplification of his book was that the markets aren't fair. That the sort of big players have got an unfair advantage, and that was a bad thing. I mean, again, I'm not going to. Let's not get too deep into that, but let's touch on it.
Well, let's talk about that. So I spoke to Michael several times. Was interviewed by him for that book, and he quoted me, and I can't complain too much because he spelled my name correctly and he quoted me correctly. But I actually fundamentally disagree with his thesis. And without getting into the weeds on it, the term legalized front running, which he used, is really, I think, a misdescription of it. And if you look at what's happening, are the markets fair? Okay. It really depends on how you look at it. Can an individual compete with Virtu or Citadel or somebody like that, in the second to second or microsecond to microsecond kind of trading? The answer is no, right? Is that a bad thing? I don't think it's a bad thing, right? I can't go onto a football pitch, and compete with, professional athletes. That's not necessarily a bad thing, right? And if you look at actually what is best for investors, right? The best investment strategy is put your money in, diversified mutual funds, index funds, and so forth, and not to actively trade. I mean, all the studies that have been done basically say that actively trading is actually bad for an individual's portfolio. And actually, if I go back, 40 years when I walked onto the trading floor at Salomon Brothers, I realized even then, I as an individual have no chance of competing with these guys who have more access to data, more information. They have information on the markets from each other and the order flow that they're seeing and so forth. So it's never been a level playing field, but I don't think it needs to be, right? Because individuals don't need to be performing the same role that institutions are. Now, are people getting taken advantage of or ripped off, in trading? I don't think so, right? So for the most part, the markets again they're very efficient and they're very fair. If I have a couple hundred shares of Microsoft to buy or sell, I can do that very easily.
Institutional market.
Yeah.
Operating, so there's the liquidity there.
That's right. I can't compete with them in their game, but that's not a game I think that individual investors really, need to be or should be playing. And to the extent that they want to play in that, it's never been a level playing field.
And I mean that I think the whole latency thing was rather a fun thing, because I think what you were doing with blowing up hillsides was because trying to lay a cable between New York and Chicago and get the faster signal, and the speed of light is the limiting factor.
Yeah.
But also bends slow things down. So a straight line is the fastest. Was that one of your projects, I seem to recall?
Yeah, I mean the fundamental idea there was basically to reduce the latency between the cash markets and the futures markets, and that was done by, as you said, blasting through rock, digging trenches, and so forth. So I guess a couple things on that. So let's just talk about latency and how long has latency been going around. So as you articulated at the beginning of this, I spent a good chunk of my career with Reuters, later Thomson Reuters and Refinitiv. If you go back, right, Baron Julius Reuter, right, how did he get started?
Pigeons,
with carrier pigeons, right? And there was a telegraph network in Europe. There was a gap between Aachen and Brussels. And because there was no telegraph line there. And so at the time, information was carried between Aachen and Brussels by train. And he recognized that if you had carrier pigeons, you could actually get the information both more quickly between those two locations, but also you didn't have to wait for a scheduled train, because the trains didn't run every minute, right? The trains only ran every couple of hours or whatever. So if there was a newsworthy event, you could transmit that information more rapidly. And so, of course, institutions, and ultimately that got transmitted to London, so institutions in London were willing to pay Reuters for news and information that had a lower latency on it than was delivered
and
via.
It just went on and on. Is that still going on? I mean, I tell a joke on one of my training courses. It's an old joke that's been told a million times. The two men walking through the forest, and they see a bear in the distance, and the bear starts coming towards them, and one man starts putting on his running shoes, and the other guy says to him, what are you doing that? You can't outrun the bear. And he says, all I need to do is outrun you. I think the point I often try to make is it's just a race. There's no absolute. There's no perfect speed. It's just you've got to be faster than the other guy.
That's right. Yeah. So there is no, there's not a single speed that you need to shoot for, and you don't need to get to zero latency, right? You just need to be faster than the next guy, or the next gal in that particular race. So, if you go back a couple hundred years, you were talking about latency in terms of hours. And then, of course, that reduced to seconds and so forth. So when I was at Instinet, we actually measured latency, but it was originally that was screen-based trading. Yeah. So you had traders looking at screens, and we knew that if the latency of the system got to be more than about a quarter of a second, that the traders, the clients, that is, could perceive the difference.
Human eye, yeah.
Yeah, because it was a person looking at a screen, right? So fast forward 10 years or whatever, And I was at Radiance, and we were connecting people, and by that time people were trading electronically, not just screen-based electronic, but algo-based electronic. And one of the salespeople walked into my office and they said, we made a change over the weekend, and this particular client is complaining because their latency increased by, I think it was 50 milliseconds or something like that. And I said, 50 milliseconds? How did they even realize that? And it turns out that and why do they care, right? And they did realize it, and they did care. Now, people are looking at nanoseconds, and again, the time granules kind of get smaller and smaller and smaller over time as the technology improves, but it's still about, I just need to be faster than the next guy.
But again, an observation I make, and I'm curious what your take is, it's only a very rarefied part of the market, a small part, who bothers about that. The vast majority of the market isn't operating at those speeds. Is that a fair comment?
Yeah, so the way I think about the market is I think about it in a couple of tiers. So, and it's oversimplified, but it helps to think about it. So at the very top of the pyramid, if you will, or the tip of the spear, you have, let's say there's probably 20, 30, 40 firms, that make their money by being the fastest. They have strategies that are arbitrage or similar kind of strategies, and they have to be the fastest, or not 100% of the time, but at least statistically a large enough percentage of the time, they have to be fastest, because if they don't, they will miss out on that arbitrage opportunity. Somebody else will have captured the arbitrage. The market will have adjusted to it. And by the way, going to your question on fairness, one of the benefits of the very latency sensitive, high frequency traders is they arbitrage out inefficiencies in the market very quickly. So I would ask the question, is it fair for somebody to pay a price for whatever instrument that doesn't accurately reflect all the information available in the market at this point in time, simply because the market has not arbitraged out, that price differential?
There is a sort of natural correction, or that they play that role. Otherwise, there'd be arbitrage everywhere, and that's the whole, which isn't really the market. You should be buying something because it's good and you think the price is going to go up, not because somebody doesn't realize that the price has changed.
That's right. So if there's new information in the market, it takes an amount of time for that new information to be reflected in the price. If I happen to be trading on an exchange and that price has not yet been reflected, then I'm not getting a fair and accurate price that reflects the current state of information in the world. And what causes those prices to be, corrected and to reflect that information is the guys who have those arbitrage strategies, who look at that information and reflect it in their quotes, basically.
I'm going to wrap. We could go on this topic. We've got two more to go, but I'm going to finish off with one very high level question. There's no easy answer to this one, or true answer. Which is more important? Is the actual execution side, the actual transactional side, all the systems for actually conducting the trading, versus what we start, the market data systems?
Right.
I mean, I think I've heard the phrase view and do. You view something and then you do something, i.e. you trade. I mean, what's your view of the sort of balance between those two, or the relative roles?
So I guess I'll give you two answers. So the first answer is they're both important, right? So if you have delays getting the market data to the point at which you're making a decision, then your algorithm or whatever is making that decision is going to be incorrect, because it's based on stale information. And equally, if from the time you actually make that decision to the time your order gets onto the venue, if that gets delayed, that's bad as well, because the price may have moved, by that time. So to me, they're equally, important. But the second answer is very much, it depends. So, and the reason it depends is it depends on what your objective is, right? So I love technology, but you have to look at technology in the context of what's the business objective that you're trying to achieve. So I'll go back to my pyramid analogy. So you have, let's say, 20, 30 people or firms who are trading on the basis of latency. Those are the guys who would sell their grandmother for a microsecond, or these days they'd sell their grandmother for a nanosecond, right? They just need to be faster than the other person because they want to be, that's how they make money. The next tier is you have firms, say a brokerage firm that has an agency execution business. It's not Credit Suisse AES now. I guess it's UBS AES post-merger. But anyway, you have the execution businesses like that. And they don't make money. They don't capture alpha by being fastest. But if they don't have good performance, they have what's called slippage. So, they're trying to deliver an execution that is in line with the market. And if their systems or their networks or whatever their technology is, isn't fast enough, then they will have a subpar execution. And if you're an actively trading fund or an actively trading individual, execution quality eats into the performance and the returns, of your investment strategy. So you need to have good quality execution, not because you're making money from it, but because you don't want to lose money from it. And then the third tier is you have actually people who don't care about latency at all. So you could have, let's say it's a long-only asset manager, and they know they want to own whatever, security. They could do something like an end-of-day cross, and just put their orders in because they're not interested in the volatility up and down intraday. They are benchmarked and they are measured on end-of-day pricing. So you just put in an end-of-day cross and the orders match.
It's a longer-term perspective. They're not intraday or day traders, if you will.
That's right.
They're taking a longer view.
Yeah, and if you look, let's say a private equity firm, right? So a private equity firm doesn't really care very much about the ticks up and down, second to second. They really care about what is the health of this business and the market that it operates in, and is this business going to grow at X% over 5 or 6 years? And so if they give up a basis point or two, in entering that position, it kind of doesn't matter because it's lost in the noise.
We could go on. So I'm going to say, by the way, this is going to be on YouTube, and there's a wonderful system of comments. So I would love people to comment on this. And also, I want to continue this conversation further down the line in future episodes and dig deeper into different aspects. So I'd ask people to comment and say, well, which aspects are they most interested in? I mean, I suspect you...
Please be kind, commenters.
Of course, only kind. And I think I don't know, I love talking about Triarch and the good old days, green screens and everything, but I mentioned that to some of the newer participants, and what's a green screen? Anyway, that's a generational thing that, again, we're going to talk about in future episodes. So that's the end of our first part. We're now going to move into the next part of our conversation. Again, something you and I have talked about, and normally talked about is me coming along saying, Brennan, can you explain this to me because I don't understand it, and you educate me on that. So AI, I remember coming into your office and talking about AI before we were all talking about generative AI, but we are suddenly, it's just all gone mad. I mean, I printed off a picture earlier on of the Gartner hype cycle, trying to remind myself, I don't know where I put it now. Actually, I've got it below me, talking about the innovation trigger, the peak of inflated expectations. I love these things. My favorite, the trough of disillusionment, and then the slope of enlightenment leading to the plateau of productivity. I mean, AI, generative AI, or even AGI, which is artificial general intelligence. I mean, what's going on? And not in the macro world, in our market data world. What matters? What should we care about? What's going on? What's happening in our little world? My little world. I mean, you're slightly outside of it, but you've been in it.
Yeah. So I guess the first thing I'll say is AI and its application in finance is actually not particularly new. And I mentioned Solomon Brothers, which, for those of you who are younger, that is, was years and years ago absorbed into Citibank. But back when it was actually Solomon Brothers, the investment bank, they actually did invest in AI technology, and they had machines.
Was that where Mike Bloomberg came from, Solomon Brothers?
Yes, that's
Anyway,
right.
I digress. Go back.
Yeah, Mike ran a bunch of the technology at Solomon Brothers, and yeah, that was the genesis of Bloomberg. But around the time, actually shortly after Michael had left Solomon Brothers, they actually hired a team. I'm blanking on the guy's name, but there's a guy who actually came out of Yale, PhD in artificial intelligence. So let's say this is around 1986 or so. So, I mean, almost 40 years ago. And they bought machines from a company called Symbolics, which was one of the first dedicated AI machine, companies that ran a programming language called Lisp, which was a programming language that came out of MIT. And Lisp was basically designed for symbolic manipulation. So most programming languages are very good at calculating numbers and building algorithms and so forth. But if you're trying to manipulate symbols, Lisp was a particularly good language, for that. So they have been using, AI technologies for years. And you look at some of the funds, Millennium, Renaissance, so forth. They won't share obviously their specific strategies, but they're populated with people who came out of Columbia PhD programs in computer science and so forth, and they've been applying artificial intelligence technologies, basically to find inefficiencies in the market and to be able to arbitrage out those inefficiencies and make money on those.
Is that all sort of pattern recognition, trying to identify where there's an anomaly in a pattern?
That's
a bit
right.
like with X-rays, they're saying AI is very good for spotting things that humans can't spot.
Yeah, so AI is obviously it's a very broad topic, and there's a lot of different techniques that are used in AI. So, for example, if I go back to those Symbolics machines at Solomon Brothers, those were building more what you call rules-based systems. So basically, you built a series of rules that kind of effectively, if this, then that, kind of things. Turns out, rules-based systems are very difficult to build up all of the rules that you need, especially when you have to accommodate all of the different exceptions to all of those rules. So let's take an example, right? Language translation, right? So there have been over the years many systems built to do language translation, and traditionally the AI techniques used to do that involved a grammar and a vocabulary, and then a whole set of rules for how you deal with exceptions to the grammar and the vocabulary, and that developed or delivered incremental results over the years. They kind of worked, but not great. And basically, the big breakthrough there was Google came along and said, actually, we have massive amounts of data in different languages. And so if you take a text, say in English, and you take the same text in French, and you train the model on it. So this was now using what's called neural networks. So a neural network is basically, as you said, it's a pattern recognition system.
Are we to large language models yet, or is that coming?
Neural networks are really the foundation on top of which large language models are built.
Yeah.
Right. So a neural network basically looks at a pattern and it generates a positive signal if something matches a pattern that it recognizes. It's effectively a statistical recognition kind of a technique, right? It says, yes, statistically, if I've looked at 1 million pictures of cats, statistically, this new picture kind of looks like a cat. And it has different degrees of probability that actually is a cat. And so they did the same thing with languages. And they said, okay, if you see this sequence of words in English, statistically, that tends to correspond with that sequence of words in French. And so you could actually feed in one language and it would translate into another language, and it didn't know the grammar and it didn't know vocabulary and it didn't have any rules. It just knew this pattern of words in this language correlates with this pattern of words in that language. That's an anthropomorphic term, and it's we're sort of humanizing it. It doesn't learn in the sense that you or I learn. But yes, it learns. It's not explicitly programmed. So large language models basically, so Google basically recognized with large language models, and others did as well, they basically recognized we have huge amounts of texts now available because all this stuff has been digitized over decades. And we have massive amounts of computing power that can crunch on and process all of this data. And so we can now apply that to languages, not just for language translation, but to interpret, documents. And so then so that basically was the genesis of large language models, right, which are processing massive amounts of text. And generative AI is basically taking that and saying, okay, given this particular prompt, right, so you ask a question, that's a prompt to the large language model. If asked this particular question, based on the corpus of data that I have digested from the internet, what is the most likely answer that is going to come from that? And it basically, it will generate, an answer, and it will back test that and say, okay, that corresponds, yep, that looks good effectively to, what other answers have been, for this. So it doesn't have intelligence in the sense that you and I would think, but it says, okay, given this question, statistically, what are the answers that most likely correlate effectively with that kind of question?
And it's that neural networks, large language models, generative AI,
right,
chatbots, and all the rest
yeah,
that's caught everybody's imagination in the last year and a half.
That's right.
How do you see that affecting, benefiting, being applied to our world of the financial, the capital markets, and I suppose our little subsector, market data?
Right.
I'll throw in two observations or two thoughts that I've got. On the one side is, how can this whole new approach be applied to the data, the market data that is being sent to all these big financial institutions? How can they use this new generative AI capability to make some sort of sense, to infer something from it, and therefore trade better? So that's one compartment. And then the other compartment, I suppose, is, I don't know, the industry that is market data. Can it use AI to generate market data and to create better market data? I don't know if those are separate things or the same thing.
I think they're similar. They're related, right? So one is it's the vendors doing it to add more value, to their data product, right? And then the other is the consumers using it to extract more value from that data product. And you can kind of shift that value, one way or the other, right? So the very sophisticated consumers, and certainly you look at like a Millennium or Renaissance, for example,
big hedge funds,
they will do that themselves. Right. Whereas the smaller institutions, or frankly, a lot of the banks, because they just, as large as they are, frequently they don't have the resources, to invest in those things. They will buy that as a product from the vendor. But either way, the technology is available to do that. So a couple of thoughts. So one is the AI techniques, that we're talking about at least, are not particularly creative, in the sense that they don't create anything new. They won't have any brilliant new insights, because effectively they're spitting back what they have read and processed, right? So you're not going to get unique, unusual kind of insights. But what they are very good at is replicating all of the drudge kind of work that is very predictable, and that doesn't take a whole lot of imagination or creativity. So if you sort of look at the food chain of market data, so the data vendors themselves onboard data from different sources. So some of that comes from websites. For example, power plants have websites that post, energy consumption and energy prices and so forth, right? So the data vendors extract data from those to put into their databases and then to deliver downstream, to that. Those change all the time, and the formats of those change. And so trying to figure out, where that particular field is on the screen and so forth or on the web page, historically that was done by analysts, usually in low-cost offshore locations, India, the Philippines, and so on. A lot of that kind of work is already being automated now using AI kind of techniques, because it's very good at pattern recognition, saying, oh, okay, that looks like a energy price on this particular website, and so I can recognize that and feed that into my database. So you have it at that end.
And it's sort of that whole unstructured versus structured data.
Yeah.
Is the AI, with generative AI, good at creating structure out of unstructured?
That's right.
Yeah.
That's right. So if I go back to Triarch Trep or RTDS or et cetera, that's all dealing with very structured kind of data in very rigid kind of formats. There's not as much value add from the large language models in that area. On the other hand, if you look at things like earnings call transcripts or research reports or
the whole alternative data world, which is also,
right.
I don't know, that's the last 5 to 10 years.
That
lends itself to this.
That's right, because alternative data means different things to different people, but to me, fundamentally, it means unstructured, data that was not created for the purpose of investing or trading. It's just data from other sources that you can use to glean insights from. So, and it tends to be, a lot of it tends to at least to be textual kind of data. So that the AI technology can be used really to kind of synthesize that. So you could take, a 50-page equity research report, from a broker, and somebody wants to know, what does this mean for my portfolio, right, or for my position? And so you can use AI technology to summarize that and deliver answers, from that. Or you can take an earnings call transcript and say, okay, well, what was this CEO really saying, and what does that imply for earnings?
There's one danger that I've become aware of, and I'm not sure I totally understand it or agree with it. I'm just beginning to learn about it. Mm-hmm. And it's all to do with the whole intellectual property area. And I think the way it was described to me was not in the market data world, but in the more generic website world. If I've created this wonderful website that analyzes all the restaurants in Brighton, which is a town near me, and writes up little reports on all of those, and therefore, if David Anderson with my wife wants to go to Brighton, we look up on the website and there's all the latest information about Brighton restaurants.
Right.
Then along comes whoever's scraped all that into a large language model. And now when you ask for Brighton restaurant, you don't go to that website like you did with a Google search.
Right.
You get a nice little report from ChatGPT or something, or Copilot or whatever it is now. But all the work was done by that little company, built a website, and they no longer get the advertising revenue.
Right.
I wonder if you can take that analogy into our world. There were all those people in wherever they were reading all those reports. I don't know if that's the right analogy, but are there some dangers here? What are the dangers?
So I think there's two dangers. So one is exactly what you've articulated, which is to say, that it's very difficult to protect digital data, right? So you can present data on a screen. You can do things like watermarking and so forth, right? But once you make data available in a digital format, which most of the vendors, at whatever level of supply chain, right, whether it's broker prices or exchanges or the aggregators, like Bloomberg and Refinitiv, they want to supply their data in a digital form because that's how it's most useful. Once you've supplied it in a digital form, then it's very easy for somebody to ingest that data and use AI technology to add value to it in some way. So I think, the challenge there is going to be probably less a technological challenge, because you kind of can't keep the cows, once the cow's out of the barn, right, you kind of can't keep them from wandering around. It's more a legal and commercial and contractual kind of a challenge. And you have to be very clear on what the usage rights are associated, with the data, and make sure that there's enforcement mechanisms for those.
A thought just struck me. You can't copyright a fact, can you?
Sure.
I'm not a lawyer. Copyright is,
right.
What is copyright? Mm-hmm. An idea, a fact, that Bet's restaurant in Brighton serves steak.
Right.
I wrote that on my website, but it's a fact.
Well, best restaurant, I guess, is a bit subjective. If you're a vegetarian, that may not be the best restaurant.
Yeah.
So
it's gonna sort of this whole thing. I don't know. What's coming next? What is the most current debate or issue that we in our little world of market data, what would you advise that we should focus on? What should people better understand?
Well, I think this goes back to the risks question, and one of the other, so that you've got the copyright and the intellectual property associated, risks. The other risk, I think, is what's called hallucinations, right? So these large language models can, quote, hallucinate. And the challenge there, I think, is that people look at that as a bug, right, if you will, to be fixed. And in fact, it's actually a feature. Put another way, it's actually intrinsic to the design of generative
They're being helpful. They're being helpful.
Yeah. Generative AI is designed to hallucinate. Effectively, generative AI is designed to create, to generate some text or in some cases pictures or now video, and it is creating something. It's creating something that's based on its knowledge base and everything that it synthesized, right? But it's creating something, and so I think the danger is. You have to recognize that is not just a bug, it is intrinsic in how these things work. And yeah, there are people who are putting specific guardrails around saying, okay, well, let's check that make sure that that's actually accurate and so forth. But it's very difficult. You can't have guardrails for everything. It's just not possible, right? So I think people have to be very careful about how they use the technology and recognize that it's a valuable input for a human being to make a decision. But you have to be very careful about depending on it, too much to actually generate the final output. So I think, if you look at you look at risk, right, and you look at various risk models will identify red flags, whether it's for money laundering or other forms of cybercrime or whatever. At the end of the day, you still need to have an analyst look at those red flags and say, so David Anderson withdrew 100,000 pounds, from his bank account in cash, in unmarked 10s and 20s, right? Is that money laundering? Well, it might be, or maybe it might not be. I don't know. Maybe, David was just doing it to invest in a local restaurant in Brighton. I don't know, right? So you have to have an analyst that looks at those red flags and asks the questions and interprets it, and so forth. And the same thing's true with all the generative AI stuff. You can't just, have it process something, spit out the result, and then not sanity check it to make sure it's
Again, we could talk for hours on this, but I think we've got to draw it to conclusion. And maybe this is a teaser, a trailer for a future discussion, which one of the themes that I want to talk about in the future, not on this session, is the talent pool and whatever. And again, I've just been talking to my 26-year-old daughter about changing jobs and whatever, and it's like, well, hang on, future generations, what jobs are going to be at risk? Will those data analysts, in India or whatever, frankly, might those jobs be at risk? Don't ask her now, because that's going to be for a future episode of All David Anderson Talking Market Data. So we'll come back to this, Brennan, on another episode, if you'll let me invite you on another episode. But I saved this one till the end. This is the final section of David talking to Brennan, and I loved these conversations. So this was when I came to your office and I said, blockchain, everybody was raving. It was going to make my tea. It was going to bake bread. It was going to get us to Mars. It was going to do everything. I try to remember when this was. Is it 10 years ago or I can't remember.
Probably about that time, yeah.
About that time. It was like, and you wrote your wonderful paper about the emperor's clothes. But I'd twist that and say, has the emperor put his clothes back on now? You were very cynical, exceptionally cynical. So I'd like you to describe your cynicism, explain your cynicism again. But then where are we at? Because that all faded away.
Well, it hasn't completely faded away, I think, to your point. So I guess I like to think of myself as not necessarily cynical, but let's just say
critical.
Critical, applying a critical A. And I'll go back to something I said earlier, which is, I look at technology in the context of what business problems does this technology solve, right? How can I use it to solve a business problem? And so I'll say, if I look at the blockchain or digital ledger technology, generally, it works, right? I'm not saying the technology doesn't work. It does actually, it does what it says on the tin, if you will. But you have to ask yourself the question, what problems does it solve? And fundamentally, the problem that it is designed to solve is, how do you execute transactions or commit transactions to a database or a ledger without having a trusted authority, right? A central authority, right? And so it basically distributes that trust, if you will, right? And so you don't have to have a central authority. You basically have a network, of machines that are running.
Cryptocurrencies was
Exactly. So let's park the cryptocurrency thing to the side, because my view on that is actually very simple. It's effectively, it's gambling, right? The currencies themselves have no intrinsic value. It's like casino chips, and if people want to gamble, fine, let people gamble. And my view is cryptocurrency should be basically regulated the same way that casinos are regulated, with all the disclosures and so forth associated with that. And gambling won't go away, right? People will always gamble. I will say, by the way, as a side note, people say, well, the financial markets are all gambling anyway. And there's certainly some truth to that. However, the gamblers are there basically to facilitate and provide liquidity to the actual investors, who are investing in the market. And so even the gamblers serve some social, purpose there. Whereas if it's just pure gambling for gambling's sake, which is what the cryptocurrency business is, it's just pure gambling. So anyway, going back to the technology, so you have to ask yourself then the question, if the problem this solves is eliminating the need for a trusted authority, how many actual business use cases are there that A, don't want a trusted authority, and B, where the effort to achieve that distributed trust is actually worth it? Because it turns out actually achieving that is very difficult. And I'll explain why. So the software itself, yes, the software works and you don't need a central authority to commit transactions. However, people need to write software. Somebody needs to maintain software. If I go to our world, market data specifically, we're all familiar with data standards and formats, right? So somebody needs to define, what is a credit default swap? How do you represent that in data? What's the actual data format for that? And of course, that's always changing, right? There's new instruments. Instruments are changing. There's new terms and conditions associated with bonds, et cetera, right? So fundamentally, while the technology allows you to operate a platform without a single trusted authority, at the end of the day, somebody needs to define the data standards. Somebody needs to write the software. Somebody needs to maintain the software. And so if you're trusting somebody to do that, you're effectively trusting that person as that central authority. So kind of what's the point of a technology that eliminates the need for that central authority?
Have you seen, again, whatever it was 10 years ago when it was it was going to solve everything.
Right.
And then my simplistic views, I didn't recognize or see it solve anything. You told me it wasn't going to, but then also manifestly, I couldn't see any examples of it.
Right.
Has anybody done anything that has slightly diminished your critical, cynical view to the point, well, that maybe that little sort of...
No, because and it fundamentally comes down to, because in practice, there's actually value provided by trusted authorities. And all of the examples, for just purely pragmatic reasons, all the examples where people have tried to apply this technology have devolved to a single central authority implementing a system using blockchain. So let's take an example that we all know that blew up, right? The chess replacement system for the Australian
ASX in Australia, yeah.
So it was done using distributed ledger technology, but at the end of the day, it was basically the Australian Stock Exchange and Digital Asset Holdings that were building and maintaining this system. So if you were Macquarie or ANZ or any bank, trading in the Australian markets, you needed to trust those organizations to write the software correctly that would correctly, track your trades and post your dividends and et cetera, right? So So even though the technology allowed it to operate without a central authority, in practice, there was a central authority that was delivering that solution that you were trusting, to do it. JP Morgan has done things like JP Morgan Coin and so forth, right? But at the end of the day, it is a private system operated by JP Morgan. And so you have to ask the question, well, why couldn't they have used Oracle or SQL Server or some traditional database to do that? And the answer is they could have, right? So the one thing that it has done, which is interesting, it has a marketing benefit, right? So there were a lot of workflows in our industry that were done via fax, email, paper, whatever, that have been unautomated, for years. So I'll take an example. Broadridge, has introduced a system in the last, year or so, in the repo markets, right? So a lot of that repo data and trading, has been done very, very manually, very inefficiently, and so forth. They embarked on that project a number of years ago, and because of the hype of blockchain, it was greenlit. Somebody said, "Oh, okay, this could be our proof of concept project, and we'll apply this to the repo markets." If somebody had gone to the chief technology officer or the CFO and said, "We want funding to automate this thing, and we're going to use SQL Server," they probably wouldn't have been excited, and they probably wouldn't have written the check to finance it, and it probably wouldn't have happened. But because there was a lot of attention to blockchain and it had some marketing value, it got funded. And so as a result, there are a number of workflows in our industry that have been, inefficient and unautomated for decades that have now been automated. And so arguably that's a good thing.
But it's going back to that Gartner hype cycle. I mean,
Yeah.
I'm old enough. I remember the internet, that's now ubiquitous. But I remember when it first came in, and like companies were putting internet, floating,
Sure.
anything that sort of says they were internet or World Wide Web or something that helped them. And then you're saying, you're right, with blockchain or whatever. And then now with generative AI, I mean, television adverts, something with generative AI. I'm trying to think, where's the generative AI in whatever they're doing? There's just these hype cycles. So, I mean, can you see any hype cycles coming down the track? What is a sort of conclusion to the whole conversation? I mean, what's next on the horizon? What is cool to talk about? Come on, give me a couple of cool. That's an unfair question to hit you with at the end, but
honestly, David, I think and one of the things I track very closely is where venture capitalists and others are investing money, because I do some advisory work, with VCs and private.
Yeah, that's what you're sort of doing now, I think.
Yeah, and right now, it basically AI and generative AI have basically consumed all of the VC capital that is going there. So, I think outside of our industry, I think the interesting things that are happening are in things like green energy. Right, so that's where things are going. To me, if I were,
or maybe not, given certain political situations.
Well,
but
I think in the
let's not get political.
In the United States, I think ESG generally and green energy, we're going to take a hit. That said, there's actually been some fascinating analysis on the economics of solar energy and what's happening with electric vehicles, and I think we've now actually crossed the tipping point where, set aside government incentives or things like that, solar energy is actually going to be making great strides over the next 5-10 years and displacing coal and oil, and so forth. So I think there's enough momentum behind that irregardless of what happens in politics in the United States, that momentum is there. Anyway, in our industry, I think I don't see any new technology on the horizon that is dramatic or different. I think in the markets, there's more interest in private markets, private assets, and so forth, because a lot of the publicly traded, public listed things, a lot of the alpha opportunities have been captured there. So I think people are trying to deal with, how do I invest in, bridges and infrastructure kind of projects or green energy projects or other private assets, and how do I get data about those kinds of things that's not readily available in market data? So those are the interesting challenges,
Yeah,
there.
because what is hot and cool at one point becomes commoditized, a phrase we often hear, and then you have to find the next hot, cool thing. Or we were talking about hedge funds earlier on, and hedge funds like stuff to be difficult.
Yes.
They want it to be difficult. All the vendors out there are trying to make things easier, but there's a certain section of the market that wants it to be difficult for everybody else because they're so clever.
Yeah.
They can work out the difficult stuff.
That's absolutely right. Yes.
So I think, yeah, spotting what the next difficult stuff is going to be is interesting. So look, Brennan, I mean, any final thoughts, words of wisdom? I didn't get as many jokes in as I wanted. I mean, I don't know.
I guess, well, maybe not words of wisdom, but just going to your point in terms of the difficult stuff, right? So, I mean, one of the things that we're seeing now, so this is not a technology thing, but electronification of markets has been going for decades now. And we're now seeing fixed income markets, become much more electronic.
Yeah.
And of course, fixed income markets are not monolithic, right? There's a lot of subsets of different fixed income instruments. And so I think where there's interesting activity that's happening in our industry, and again, not necessarily new technology per se, but is applying a lot of the lessons learned and then also modifying them to reflect, the structure of the markets in fixed income. And again, there are some assets in fixed income that are highly liquid. You look at TradeWeb and Market Access and so forth, right? You look at, treasuries and so on. Those are already pretty liquid. But then there are less liquid ends of the market.
Yeah.
And I think what we're seeing is kind of a steady chipping away at those. And to your point in terms of, the hedge funds and others like difficult things, those are, in some of those fixed income markets, pricing is more opaque. Liquidity is less available. They're generally less efficient markets, and so there's more alpha opportunity there. But what's happening is there are vendors who are chipping away at that and who are steadily working on automating the electronification of those markets, and along with that, the availability of pricing data, for those markets. So it's not a sexy thing like an AI or a blockchain or things like that.
But maybe technology follows and sort of will create solutions to that difficulty or something. And it's something I've often been aware of over the last many years. In my various roles, get very fixated on the equities market, talk an awful lot about the equities market.
Right.
And I keep trying to remember there's bonds, fixed income, there's foreign exchange, there's commodities, but still equities seems to suck in so much attention. Again, that's a topic for another conversation.
Yeah, the equities markets are huge markets, and frankly, for most people as individual investors, it's easier for them to understand, do I buy shares in Tesla or in Microsoft or whatever, versus how do I feel about this particular credit default swap, right? It's just individuals can't get their heads around that as much. So I think, we probably do pay disproportionate attention to the equities markets.
Brilliant. Well, look, I'm going to say thank you. I'm going to say I'm sure if you'll come back further down the line when I have this is episode 1 of David Anderson talking market data, and I hope there's going to be many more episodes. So I'm going to draw this to a close, and I'm probably going to edit from this point.